Welcome back to Market Day Report. I'm Scott Shellady, otherwise known as the Cow Guy. Thanks for tuning in with us, if you're just tuning in with us, or thanks for staying with us all day today because we've got loads to talk about. It seems like every Monday I come in, the world's melting down around us. It's not necessarily our products as much, but boy, oh boy, we sure do get affected. So why don't we jump in and take a quick look about what is being affected and see what's trading in that corn market. Corn, that March contract is down just 3/4 of a cent. 5.92.5 is last. We've been as low as 5.87. Maize off 3/4 of a penny. 5.93.5, and considering what's been happening around it, that's not too bad. Soybeans are a little stronger, at least they were last time we checked, and they still are. Let's look at that March contract. That's up 7 cents at 12.95.5. Maize up 6 3/4 with a 13 in front of it, right? 13 even and a quarter cent. All right, wheat was weak. This is Chicago, but it's not as weak as it was. We got that March contract off 3 1/4 cents at 7.71 3/4. Maize off 4 cents at 7.74 1/2. All right, how about the hard red wheat in Kansas City? This is making a comeback, actually. March is off penny and a half, 8.08 1/2. Boy, we were down about 15 cents lower than this earlier. Maize off a penny and a half as well at 8.08 3/4. Spring wheat in Minneapolis, what's been happening there? That March contract's off 7 3/4 cents at 10.14 3/4, while maize off 6 1/2 at 10.05 1/2. And let's take a quick peek and see what's happening in this weak cotton market. Cotton's, it's getting weaker every time we check. 262 lower, 262 points lower than that March contract at 104, spot 68. But this is the pleasure of the morning. We get to introduce in Chris Swift from Swift Trading. Thanks for joining the show today.
Absolutely. Good morning.
And we've got lots to talk about.
There is quite a bit.
And so the markets were roiled yesterday with some politics. And obviously, we've got more and more Omicron news coming over from Europe. Mm-hmm. I don't think it's about the Omicron. I think that's what the headlines are going to be. I'm worried about the economy a little bit here. We've had Goldman Sachs came in yesterday afternoon and downgraded Q1, Q2, and Q3 of next year for growth. So I think what we're seeing happening in the equity markets, I think our markets are holding up generally pretty well for a week that we wouldn't expect a lot of action. Mm-hmm. But you came all the way into the studio, so I'll shut up and let you start talking. So what do you think?
Well, we noticed that the grains just about every Monday morning start off a little bit lower, and by week's end, we find some kind of firmness in them. So even though we know that whatever this Build Back Better bill is, that it's probably not going to be passed for the first of the year, so that kind of takes some of the objective of the money out, but yet grains still performing very well. So there's a need for grains out there, and there's still elevated livestock production. We now using them more for energy now than what we have been. So clearly we've got some good grain demand out there.
You know, if this 550 point lower Dow doesn't shake any weak longs out of the grain markets, I would say that's pretty strong for us.
Absolutely.
Right. So you've got new crop corn, 550-ish. I mean, that's pretty good at this time of year.
Right.
And the same with beans being as high as they are as well. I think for them not to really sell off in the face of what we're seeing happen, say, over in the financial markets, I think you're exactly right. That's, we still need to eat. We still got some elevated input prices, which are keeping, I think, the output prices higher than normal too. So even though, I guess I would say, the more often this happens over in the fixed income and equity world, the less we react to it. I kind of feel like that's happening today.
Well, and especially in the commodities, because commodities have a picture all of their own right now. And that is something that we've not seen for multiple years because we've been in a bear market, overproduction. And now that we have started with the COVID, there's been some production gaps in there. And every now and then we're going to see one of those gaps, and that's going to probably keep prices more inflated than giving them a reason to go down.
Right. Awesome stuff. All right, stay right there. I know you're not going to go anywhere.
All right, no.
But we're going to go away, pay some bills. We'll come right back with Chris Swift from Swift Trading, talk livestock after this. Welcome back to Market Day Report. I'm Scott Shellady here with Chris Swift from Swift Trading. Chris is a livestock expert. Let's get in to see what those livestock prices are, and so he can tell us what's happening there, because we're not quite sure ourselves here. Let's take a look at live cattle. The Cow Guy likes to take a look at live cattle. I would say with the live cattle, with the range and on the day and the change, when the change and the range are tiny, that screams holiday market to me. So let's take a look. February's off 70 cents. 135.72 is last, but look at the range. It's a 50-cent range. And April's off 50 cents as well at 140.10. It just ticked up a little bit, 140.12. So I'm going to say, let's call that a holiday market. That looks like holiday all over it to me. Now, we had feeders. They were weak Friday, and they're a little weaker here again today. January's off $1.10 at 159.15, but again, that's not a big range either. March is off $1.27. 160.42. I guess this is a good one to say, you got to give the bulls a reason to buy every day, and it doesn't look like anybody gave anybody a reason to buy feeder cattle today. So We'll call that one lack of any bullish news. And then finally, let's take a look at what the lean hog market's got for us. This one's a little easier as well. $1.10 lower in that Feb contract, 79.70. Again, that's not even a dollar range on the day so far in lean hogs. We've got April off 80 cents, 83 spot 97. All right, Chris. What do those three boards, what picture does that paint for you?
Not a lot of anything. It's pretty much convergence of basis. When we know that the futures traders probably don't want to be the marketing agent for these livestock producers, so they're going to curtail some of those premiums in the market and just say, till after the year and we see something a little bit more positive, then we may add those premiums back onto the futures again. But the feeder cattle market has done nothing but just converge the basis. The futures have come down to the index. The index has barely budged. Same thing in the lean hogs. The index has barely budged. So the futures don't really have much place to go but converging to them until there's something that says out into the future, now we can anticipate this.
All right, so I want to be wrong on this.
Okay.
But with the economy, you know, with Goldman Sachs and their projection for a slowdown, if we get some interest rate rises or at least some tightening when it comes to the taper, and I don't want to get into that, but that's and we do slow down, what does that do to these prices?
You know, I'm not real sure because we saw a distinct division between beef prices and cattle prices through the summer. It's very possible that you could see a distinct separation between the two. And beef prices may continue to go lower and cattle prices may continue to go up because there's always going to be that quintessential demand out there. You're never going to lose a portion of that. So if we do have lower numbers of cattle out there, which we're already seeing, and this spring going to be really, really interesting to whether or not the drought breaks and we start expansion all over again, which pulls every single cow and heifer out of the slaughter mix, puts them back into the breed cycle, makes for an instantaneous shortage of cattle. So those are things we don't know yet and won't know for 2 or 3 more months.
Well, we're going to make sure we stick around and have you here because you're going to make sure that we're aware of it. But I do still stick to my initial hypotheses. Number one, I don't think this is an Omicron sell-off. I mean, it's going to be the headlines, but really I don't think if you pull the car over, look under the hood, I think we got more worries about the economy. And if that's the case and we do slow down, we're going to have to keep a tight eye on what you were just talking about there. But, you know, ultimately, we're reacting less and less to what's been happening in that other world. Yeah. So it's good to see that we kind of kept our head about us and our products. All right. Yep. Thank you very much for coming in. It changed up the day. It's great to have somebody, a real live person in studio.
Good.
It's Chris Swift from Swift Commodities. I'm Scott Shellady. Let's bring it back to Nashville so I can throw it over to Janet.